Welcome back to the Deep Dives. Today, we aren't just looking at a company. We're effectively looking at a proxy for the entire Latin American consumer economy.
Yeah, we are talking about logistics, um, currency wars, and just the sheer industrial scale machinery required to hydrate a continent.
It really is a massive operation. We are analyzing Coca-Cola FEMSA. You might know them by their ticker, KOF.
Right.
And I want to set the stage immediately for anyone listening who thinks that, oh, great, we're talking about soda. You really need to recalibrate.
Yeah. This isn't just another bottler. This is the largest franchise bottler of Coca-Cola products in the world by sales volume.
Exactly. If you are cracking open a Coke in Mexico City or São Paulo, Buenos Aires, Bogota KOF likely bottled it.
They put it on a truck, they navigated the local traffic, and got it into your hand. They're the infrastructure behind the brand in a huge chunk of the world.
And the timing for this breakdown is perfect. It's February 26th, 2026. The company just released their fourth quarter and full year 2025 results just 2 days ago.
So we're looking at really fresh data, hot off the presses.
Right. And it's a report that tells a very specific and frankly somewhat conflicted story about resilience.
It does. Their CEO, Ian Craig, used a very specific word to describe 2025 in his opening remarks. He said the year tested the business.
Tested. That is usually CEO code for things went wrong, but we survived.
Yeah.
It's rarely a word you use when you've just had a record-breaking easy year.
Oh, definitely not. It's a polite way of saying it wasn't a walk in the park.
So the mission for our deep dive today is to figure out exactly how they passed that test.
Because when you look at the raw data, they face shrinking volumes in their core markets.
Right, and some brutal currency headwinds. Yet they claim to have come out stronger.
They do. So let's strip away the corporate gloss and look at the actual report card.
I have the fourth quarter and full year 2025 results right here. Give me the high-level view. Did they pass the test, or is tested just a euphemism for failed?
I'd say they passed, but it's a classic tale of two timelines. If you look at the full year 2025, the picture is actually a bit concerning.
How so?
Well, volume, meaning the actual amount of liquid they sold, declined by 1.8%. We are talking about total sales dropping to 4.15 billion unit cases.
Okay, pause there. A nearly 2% drop in volume for a consumer staple like Coke is significant.
It's very significant.
That means for the full year, fewer transactions were happening. People were physically buying less product. That's not a rounding error, that's a trend.
Correct. The consumer was pulling back. Whether that's inflation, health trends, or competition, the volume just wasn't there.
But I'm guessing there's a pivot here.
There is. If you zoom in on just the fourth quarter, so the last 3 months of the year, the narrative completely changes. They managed a rally.
A fourth quarter rally.
Yeah, volume in Q4 actually increased by 1.3%. They moved 1.09 billion unit cases in just that quarter alone.
So they finished strong. It felt like a buzzer beater to save the year's narrative.
It really did.
But volume is just vanity, right? Profit is sanity. Did that late-stage volume bump translate to actual cash?
It did. Revenue for Q4 was up 2.9%. But to really understand this company, and honestly any multinational operating in Latin America, you have to look past that headline number.
You're talking about the currency-neutral results.
Exactly. You have to look at currency neutral.
We see this constantly with multinationals, and it feels like an excuse sometimes. Explain why this specific metric matters so much for KOF right now. Why should the listener care about currency neutral?
Think of it this way. KOF reports in Mexican pesos. That's their home base.
Right.
But they make a huge chunk of their money in Brazilian reais, Colombian pesos, Argentine pesos, and so on. In 2025, the Mexican peso was quite strong relative to some of those other currencies.
So when they earned a real in Brazil and converted it back to pesos for the report, it looked like less money than it actually was.
Precisely. It's a translation loss, not a business loss. It's like if you worked in Europe and got paid in euros, but your bank account was in dollars. If the dollar gets stronger, your paycheck looks smaller in your account, even if you did the exact same amount of work.
That makes total sense. So what is the real number then?
While the reported revenue grew 2.9%, if you strip away those currency effects, basically assuming exchange rates stayed flat, their revenue actually grew 6.0%.
Wow. That is a huge delta. That's double the growth.
It is. And it tells us that the underlying engine of the business, selling drinks to people, is running much hotter than the reported numbers suggest.
So the foreign exchange markets are just masking the real operational strength.
Exactly.
Okay, so Ian Craig saying the business was tested, but they learned and adjusted seems to hold water.
It does on the surface. They started the year with volume drops, but by Q4 they had turned the ship around and were growing revenue at a 6% clip comfortably.
At least on a currency-neutral basis.
Right. The key takeaway here is resilience. But as we dig deeper into the how, you'll see that the profit growth is a little more complicated than just selling more soda.
Meaning there is some financial engineering at play here.
There's always some financial engineering.
I definitely want to unpack that. But before we get to the financial engineering, let's look at the geography. Because usually with KOF, you have Mexico carrying the team. It's the mothership.
That's usually the case, yeah.
Was that the case this time?
Actually, no. The map was very divided. We need to split this into north versus south. It's almost like looking at two completely different companies.
Okay, let's start with the home turf then. Mexico and Central America. This division includes Mexico, Guatemala, Costa Rica, Panama, and Nicaragua. How did the steady giant perform?
Steady might be generous. It was actually stagnant.
Stagnant.
Yeah. Volume was stable overall for the division, but if you look specifically at Mexico, their crown jewel, the place where Coke consumption is almost a religion.
A volume declined.
Yes.
Yeah.
Volume actually declined by 0.9% in the fourth quarter.
That is genuinely surprising. Mexico is usually the most reliable market in the world for Coca-Cola consumption. Why the drop? Are people just drinking less soda?
It's a tough market right now. It's a combination of price fatigue and a really tough comparison to the previous year.
Okay.
But here's the interesting part. Even though they sold fewer bottles in Mexico, the revenue for the division still increased slightly,
By how much?
about 1.6%.
Which implies they raised prices. I mean, if you sell less stuff but make more money, the math only works one way.
Exactly. In the report, they call it revenue management initiatives.
Revenue management. That's one of my favorite corporate euphemisms. Sounds so sophisticated, but it basically just means we know you want the product, so you'll pay a few pesos more.
It is that, but it's also about the mix, which is a term we will definitely come back to.
Like selling different types of products.
Right. Maybe they pushed smaller, higher-margin, single-serve bottles instead of the big family returnables. They're very good at package architecture.
Got it.
But credit where it's due, they didn't just raise prices to save the margin. They also got some help on the cost side.
Cheaper materials.
Yeah, their gross margin in Mexico expanded because the cost of sweeteners and pizza plastic for the bottles went down.
Okay, so in the north, they sold less, but raw materials got cheaper and they hiked prices, so they squeaked out a profit gain.
That's the summary for the North.
It's efficient, it's disciplined, but it's not exactly a growth story. It sounds like managing a mature decline.
I agree. For the growth story, you really have to fly south.
Let's talk about the South America division then. Brazil, Argentina, Colombia, Uruguay. Usually these are the volatile markets.
They are, but this quarter, this was the absolute engine of the company. Volume increased by 3.8% in Q4.
3%.
And that wasn't just one lucky country carrying the rest. They saw growth across all countries in that division.
That's impressive consistency. And I assume that volume growth, combined with the currency-neutral dynamic we talked about earlier, led to some big revenue numbers.
Big time. Reported revenue was up 4.6%. But currency neutral, revenue boomed by 9.5%.
Yearly double-digit growth, that is where the action is.
And it gets better. Look at the operating income for South America. It jumped 32.8%.
Wait, 32.8%? That is massive.
It's explosive.
Okay, hold on. I need to reconcile this. Mexico is struggling to keep volume flat. South America is printing money with 30% income growth.
Right.
But earlier you said the consolidated volume for the whole company was only up 1.3%. South America must really be punching above its weight to lift the whole average.
It is. But, and you knew there was a but coming.
There is always a but when numbers look this good. You don't get 33% operating income growth just by selling a few more cans of Sprite.
You really don't. That 32.8% jump in operating income in South America and the consolidated operating income growth of 13.3% for the whole company, it isn't purely from selling more soda.
This connects to the mystery in the bottom line you mentioned.
Yes.
Okay, peel the onion. Where did the money come from?
Insurance.
Insurance? You mean like a payout?
Exactly. If you just scan the headlines, you see operating income up 13.3%. You think, wow, operational efficiency, they are crushing it.
Right.
But the report explicitly states they recognized insurance recoveries in Brazil and Mexico. Net of expenses, this totaled 1,149 million pesos in the fourth quarter alone.
1.14 billion pesos. That is not a rounding error. That is a massive check. That's tens of millions of dollars.
It's huge. And here's the aha moment. If you exclude those insurance recoveries, if you take that one-time windfall out of the equation,
And let me guess, the growth disappears.
worse, operating income actually declined by 2.1%.
Wow. Okay, that changes the entire complexion of the report. The headline says up 13%, but the operational reality was down 2%.
Precisely. That is why we do these deep dives. The insurance money effectively masked a decline in the core profitability for the quarter.
It's like painting over a crack in the foundation. The wall looks white and clean, but the crack is still there.
That's a great analogy.
So let's talk about the crack. Why did the core business decline? You told me earlier that sugar and plastic were cheaper.
They were.
If raw materials are down and revenue is up, margins should be expanding. What ate the profit?
It's the fixed costs, specifically labor and depreciation. They faced significant pressure there. Labor costs are rising globally, and Latin America is no exception.
Makes sense.
But they also mentioned another key phrase in the report, unfavorable mix.
Unfavorable mix. We hear this a lot. Decode that for the listener. What does it actually mean in the context of selling drinks?
It means that even though they sold some stuff, they sold more of the wrong stuff.
The wrong stuff.
Yeah, in the beverage world, not all liquids are created equal. A single-serve bottle of Coke sold at a convenience store has a very high profit margin. A large multi-serve jug sold at a supermarket has a lower margin.
Or maybe they sold more water.
Exactly. Water has completely different economics than soda.
So unfavorable mix means consumers were trading down, buying the cheaper options.
Essentially, yes. Or the growth in South America came from categories that just aren't as profitable as the core business in Mexico.
So even though they saved money on sugar, the cost of labor and the fact that they were selling lower margin products ate into their gross margin.
Yes. In fact, consolidated gross margin contracted. It dropped by 60 basis points to 46.7%.
That is the critical insight right there. You can have cheaper raw materials, but if your labor costs are rising, which is a sticky inflation that doesn't just go away,
And your customers are buying cheaper drinks.
your margins get squeezed.
Exactly. And you have to realize that insurance payouts are a one-off. You can't plan your 2026 budget hoping for another disaster recovery check.
Strategy for 2026. Hope for an insurance claim is not exactly a strategy I'd want to pitch to the board.
Definitely not recommended.
So the operating performance was actually a bit fragile, buoyed by this insurance windfall. It makes the resilience narrative feel a bit more engineered.
Engineered is a good word for it.
But let's zoom out to the company's foundation. A bad quarter operationally is one thing, but is the house in order? How is the balance sheet?
Oh, the foundation is rock solid. That is the one thing you cannot take away from KOF. Regardless of the margin squeeze, they are in very good financial health.
Prove it. What makes them so solid?
Well, look at how they treat their shareholders. In December 2025, they paid out over 3.8 billion pesos in cash dividends. Companies that are sweating about cash flow usually cut the dividend first.
Right. KOF's paying out.
Cash on the barrelhead.
That speaks volumes. If you're writing checks to shareholders, you aren't worried about keeping the lights on.
And the debt markets trust them implicitly. Just this month, February 2026, they successfully priced a massive bond sale in the Mexican market.
How massive?
10 billion pesos.
10 billion, that's a lot of liquidity.
It is. They split it between a 10-year fixed rate and a 3-year variable rate. But the key detail here isn't the amount, it's the rating.
What did they get?
They got AAA ratings. That is top tier. It means investors see them as a safe haven, almost sovereign-grade safety.
So they have access to cheap cash, they are paying dividends, and the banks love them. Even if operations are a bit messy, the bank account is full.
Correct. And interestingly, it's not just the banks that are happy. The sustainability folks, the ESG crowd, are giving them high marks too.
I always look at ESG scores for bottling companies with a bit of skepticism. I mean, it takes a lot of water to make Coke, and plastic waste is a huge global issue. How do they do?
Surprisingly well. They achieved an all-time high score on the S&P Global Corporate Sustainability Assessment. They scored an 81.
Is 81 actually good? In school, that's a B-?
In the corporate world, specifically in this assessment, an 81 is basically valedictorian status. They were included in the 2026 Sustainability Yearbook as the highest-scoring company in their sector in the Americas.
So they are top of the class.
They are. And this matters because for a company that relies on water rights and plastic, having a social license to operate is a serious risk management tool.
That makes sense. Being the greenest bottle, it protects them from regulation and investor backlash. It's not just about saving the planet, it's about saving the business model.
Exactly. It keeps the institutional investors on board.
So let's recap where we stand. We have a company that survived a testing 2025. They used some insurance money to make the profits look nice, masking some margin pressure from labor costs and product mix.
Yep.
But they have a booming South American growth engine and a balance sheet that is built like a tank.
That's the summary.
Now let's look forward. What is on the horizon for 2026?
Well, CEO Ian Craig was pretty transparent about the future. There is a storm cloud approaching, but there's also a very bright ray of sunshine.
Give me the bad news first. The storm cloud.
Taxes, specifically in Mexico. They explicitly mentioned addressing the impact of an increase in the IEPS tax.
IEPS. For those not familiar with Mexican tax code, what are we looking at?
It stands for the Special Tax on Production and Services. In Mexico, sugary drinks are taxed heavily to combat obesity, and that tax is going up.
That is a direct hit to the consumer's wallet. If a Coke costs 15 pesos and suddenly it costs 17 or 18 because of a tax, volume usually takes a hit. We saw a volume drop in Mexico just this quarter. 29%.
Exactly. It's price elasticity.
Yeah.
If the price goes up due to tax, demand usually goes down. We already saw Mexico volume drop in Q4 without the new tax hike fully biting yet.
So a tax hike could really accelerate that decline. It's a serious headwind in their biggest market.
It is.
So that's the threat. What is the tailwind that is supposed to save the day? What's the ray of sunshine?
Soccer.
Soccer, the universal solution to all problems in Latin America.
The FIFA World Cup specifically.
Of course. 2026 is a World Cup year.
And remember, Coca-Cola is a massive sponsor.
Yeah.
KOF plans to leverage that increased brand engagement.
That makes total sense. Nothing makes people want a soda more than watching sports, gathering in groups, and celebrating.
Yeah, it's a natural volume driver. It creates occasions for consumption that just wouldn't exist otherwise.
It is a huge opportunity. They are betting that the excitement and the marketing spend around the World Cup will offset the sticker shock from the tax hike.
It's a battle of emotions versus economics. The emotion of the World Cup versus the economics of the tax.
It's a great way to put it.
They are also doubling down on digital to help win that battle. They mentioned rolling out leading-edge digital capabilities.
This is their Shintos Plus platform, right?
Yes. It's not just an app, it's a whole B2B ecosystem. It allows the little mom-and-pop stores, which are really the lifeblood of Latin American retail, to order inventory, manage stock, and even get credit.
Oh, wow.
Yeah, it locks those customers into the KOF ecosystem. If you make it easier for the shopkeeper to buy Coke than Pepsi, they will buy Coke.
Smart. It reduces friction.
And finally, I assume they plan to keep the pedal to the metal in South America.
Absolutely. They want to accelerate that growth we saw in Q4. If Mexico is going to be tough because of taxes, they need Brazil and Colombia to keep putting up those 9% growth numbers to balance the books. So the strategy for 2026 is clear. Mitigate the tax hit in Mexico using the World Cup hype, digitize the supply chain to lock in retailers, and pray that South America keeps booming to offset any weakness in the north.
That sums it up perfectly. It's a balancing act on a continental scale.
Bringing this all together for our listener, why should you care about Coca-Cola FEMSA's Q4 report? Why does this matter if you don't own the stock?
Because it is a masterclass in how multinational giants manage volatility. Think about it. They have raw material savings on one hand, but labor costs rising on the other.
Right.
They have a struggling mature market in the north, but a booming emerging one in the south. They have currency headwinds, but operational strength.
It's all about leverage.
It is. Whether you are an investor or just interested in global business, this report shows you that you can't just look at one number. You have to see how they use the strong regions to offset the weak ones.
And honestly, how they use financial levers like those insurance recoveries to smooth out the earnings ride so the stock price doesn't crash. It really highlights the importance of digging deeper. If you just saw volume minus 1.8% for the year, you'd think they were in trouble. If you just saw operating income up 13%, you'd think they were unstoppable.
But the truth, as always, is somewhere in the messy middle.
The truth is always in the footnotes. And that brings me to the big question I'm left with.
Let's hear it.
We saw Q4 volumes recover. That was great. But full-year volumes were down. Now, looking at 2026, we have a guaranteed tax hike in their biggest market, Mexico.
Right.
So my question for you, the listener, to mull over is this. Will the excitement of the FIFA World Cup be enough to counteract that tax and keep volume growing? Or was this Q4 bounce just a temporary blip before the tax man comes calling?
That is the multi-billion peso question. Can the World Cup beat the taxman? It's a match I'll be watching closely.
As will I. Well, thanks for diving in with us today. It's been a pleasure unpacking the world of giant soda logistics with you.
Always a pleasure.
And to our listener, thanks for tuning in. Keep asking questions. Keep reading those footnotes. And remember, sometimes the most important number in a report is the one they try to hide. We'll catch you on the next deep dive.